Earnings season is where dreams really meet reality. Earnings are just not about hype. They're about the gap between what the market expects and what the company delivers. And you can announce new pills, you can launch cancer tests, you can talk about strategy all day long. But when earnings hit, the spreadsheet really decides people's viewpoint, and it's going to have a massive effect on the price. Right now, HIMS is heading into one of the most important reports yet. Off the back of the DOJ and the FDA and everything been going on, the next earnings release expected around February 23 could shift the entire narrative. So in this video today, we're going to establish the baseline numbers, what analysts are really expecting, and why guidance may matter more than actual results, and what would need to happen for this report to truly change the long-term story.
Welcome to the game, it's the instant stocks by Mikhail Kuhar.
And if you've been following along on my videos, you know over the last 4 years, we've developed our AutoPilot software that allows our team of professional traders who have already made millions day trading trade for you directly through your Interactive Brokers account. You do not need to ever send us money. As long as you got $10,000 to allocate to the trades, they can trade for you. We have a goal of hitting 8 to 15% ROI every single month on your trades. We never risk more than 10% of your portfolio. Risk management is one of our highest values, and we have almost 500 members trading with us every single day. We have members like this who are looking to add more than $100,000 to the software. And we got members like this that have bought a house with the information we've given them for trades. And you can see we have dozens and dozens and dozens and dozens of testimonials from clients that are pumped with the results it's getting for them. But if you want to find out more, just book a call below. I'll put the link under this video, but let's get stuck in to what we're talking about today. But first, let's establish a baseline and recap. In Q3 in 2025, HIMS reported a revenue of about $599 million. Now that represented roughly 50% year-over-year growth, but earnings per share came in at 9 cents. Analysts were expecting 10 cents. That 1 cent miss really mattered, and not because of the amount, but because it reinforced a theme. Revenue is growing fast, profitability is still tight. Now analysts are modeling Q4 in 2025 that some estimates place expected earnings around per share around 5 cents, lower than recent quarters. Now, why is that? Concerns around margin pressure, product mix shifts, and continued investment in weight loss and proactive care. So expectations heading into this report are cautious. That matters. Now, let's revisit prior guidance. Management previously guided Q4 revenue to a range of $605 million to $625 million. Full year 2025 revenue was guided to about $2.3 billion to $2.35 billion. Adjusted for EBITDA margins were expected in the low double digits. So investors will focus on 3 simple questions. Do they hit the revenue range? Did margins hold or improve? And what does 2026 look like? Because earnings are not just about the past quarter. They're about forward visibility and how much certainty we can see in the moves they're making and the levers they're pulling on. The tone matters as much as the numbers. If HIMS beats revenue but signals heavier investment in 2026, that pressures margins further, and the stock could still fall lower than what we're seeing right now. If margins stabilize and guidance points to improving operating leverage, the narrative could shift really quickly. If we talk about subscribers, earlier in 25, HIMS reported more than 2.2 or 2.4 million subscribers. Subscriber growth has been a core driver of revenue acceleration for them. Now, if the net adds remain strong, that signals platform health. If growth slows or churn rates rise, institutes will react fast. In platform-based businesses like this one, subscriber momentum often matters more than short-term earnings swings. Now, if we consider just weight loss, the GLP-1 and weight loss segment was projected to generate around $725 million in 2025 revenue. That makes it a massive contributor, not just a side project. So this earnings report becomes a scoreboard. And the question is, are those investments translating into durable revenue, or are margins absorbing with too much pressure? Then there is proactive care, cancer screening, heart health testing, hormone panels, labs. These categories are still early and they may not contribute large revenue yet, but the management commentary really matters here. Are adoption rates rising, or are attachment rates improving? Is cross-sell increasing? Those signals influence valuation models. Now, many analysts will still value HIMS on a multiple of sales rather than net income. Now, Why is that? Well, because early stage platforms are judged on growth, durability, and lifetime value expansion. If revenue grows faster than operating costs, operating leverage improves. And when operating leverage improves, profit growth can accelerate later. And this is when the narrative shifts start to happen, and they start to happen really fast. But the opposite is also true. So if subscriber growth slows, if customer acquisition cost rises, and if margins compress without a clear recovery path, institutions may step back a bit. And institutions care deeply about predictability, and they want more certainty in what's going to happen. Now, if we consider the side of the coin where the stock is being volatile headed into this report, some analysts may remain cautious, and now others see upside if the platform economics do prove to be durable. That divergence really creates tension, and tension creates the potential for sharp moves. If fear is priced in and results are solid, the bounce can be really meaningful. But for real long-term re-rating, it has to show progress in 3 areas: sustained subscriber growth, improved margins, and credible 2026 guidance. The other thing is obviously revenue. Finally, context really matters. Other GLP-1 manufacturers and telehealth players are reporting around this period. So sector performance creates comparison. And if large pharmaceutical companies show pricing pressure while HIMS shows adaptive growth and diversified revenue, that relative strength could support the narrative. So earnings are really a test. It's a test of execution. How well have you been executing what you said you were going to do? It's going to be a test of profitability and the direction that's going in, and a test on whether the platform story shows up in the numbers, because narrative only lasts as long as the spreadsheet supports it. So my thoughts here is the February 23 earnings window is not just another quarterly update. It could really shape how investors frame HIMS for the rest of the year. And if revenue growth stays strong, margins begin stabilizing, the narrative could shift towards a scaling platform with leverage. If not, volatility likely continues, and we'll see that in the stock price as well. So the real question to take away from this is, will this earnings report confirm the platform thesis, or will it force the market to rethink the growth story entirely? It's been a massive few months for HIMS, and like I've mentioned before on a lot of these videos, is the GLP-1 situation with Novo has been a massive test for them. They've really pushed on some edges, but with the shortage in the industry of GLP-1 coming up to that space, the revenue did start to see a downturn just when this happened. Now, coming into the reports, I'd love to hear what you guys think. What do you think is going to be the effect on the stock price when these reports come out? And do you think they keep sustaining growth like they have year over year, or do you see a massive slowdown after this big incident with the GLP-1s? Let me know below. As always, I'll see you in tomorrow's video.